Good morning. You're watching the market right here on ET Now, and after the weekend, lot has really transpired on the table. Fortunately, you've got a positive handover coming in from the global equity markets on Friday, but I think the big takeaway is going to be the OPEC surprise output cut coming in. They've announced a further production cut of about 1.16 million barrels per day, and now that takes it to total volume cut of 3.66 million barrels per day as per reports. The volume cut now equals to about 3.7% of the global demand. And if that be the case, we can clearly say goodbye to inflation going away anytime soon.
I have a very different view, Aisha. Why are you cutting prices? You're cutting prices because demand is slowing down. And demand, if it slows down, it will really have an impact on everything else. I mean, crude is one variable which will get impacted because of low demand. But if the OPEC members have rushed out to cut production, it just tells you that they want to retain market share. Because remember, oil from other producers is also hitting the market, and especially oil from Middle East, which in a sense, especially from Iraq, which was not coming out because of sanctions, and from Iran, I think that oil will also come back. I look at this as more like a market share attempt to gain market share, because on one side, Russia has entered into these side deals. Russian oil is coming to India. More oil will come from Middle East, and demand in general, which was anticipated to be higher from China, seems to be coming down. So I think this is more like a desperation. This desperation is largely because of demand cut, but not because of demand increase. And eventually that just tells you that crude is one variable which will have an impact on the demand per se. So I would read this as something which optically is not good news, but realistically it also means that the second half of this year, maybe oil marketing, maybe oil producing nations are telling you that the scenario in terms of demand is going to be dramatically different.
Yeah, absolutely. Now, if you were to just take a look at the factors as to why you are seeing crude prices spiral up, besides, of course, this output cut that has been announced, but there's also rising US stock supply. There is also, the Kurdish region supply risks, which, clearly run high when it comes to crude prices. And here's how you would assess the impact of the rise in crude prices. Remember, India imports close to about 85% of its crude requirements. So every $10 per barrel of an uptick in crude prices, that's going to increase your current account deficit by about almost $14 to $15 million, and that's almost 0.4% of the GDP. So that really is something key that we need to look out for, whether this is a knee-jerk reaction, Aman, or is it something which is going to, form new levels for crude trading?
That is going to be fairly critical, and of course we'll be watching out for how crude oil prices as well trend this week. But speaking of the kind of action that D Street clocked in last week, it was a truncated one, but we did manage to outperform our peers, surging about 2.4%. 17,359 is where we wrapped up for the Nifty, which means that as compared to some of the other peers for the week gone by, we did stand out. For the month of March as well, we did end up with a small gain. FIIs turned net buyers last week, which is fairly positive. And just mapping out the individual sectors, it was banks that was in the leadership position, followed by the metals basket. So high beta clearly played its part. And IT too packed in a punch, whereas power, telecom and oil and gas, those were some of the sectors on the back foot. Nikunj, April is a lot about truncated weeks and lots of holidays, but given the kind of headlines and what we've witnessed in the month gone by, what's in store for April?
Look, you've got 2 holidays. Not that I'm complaining, but to get a view going because of the market, because of 2 holidays would always be very difficult. Now you could ask yourself is that have we taken support at key levels? The answer to that is yes. Yes, we've taken support at key levels. From those key levels, for markets to move higher, the chances of that could be greater. Brokerages have already come out and they've said that, look, India is no longer a sell, it's a buy. The market positioning in terms of what FIs have done in the month of March, I think they've been net buyers. And there seems to be a big move which now is there in some of the heavyweights like Reliance and HDFC Bank. So I would be far more optimistic than pessimistic. I think there is reason to believe that next few days in the run-up to the earnings season, you want to be on the long side rather than on the short side. exactly 3 months ago we were, 2 months ago we were only discussing the impact of Adani Group stocks on the market, and then 1 month ago we were discussing the impact of global regional banks on the world per se. So both those concerns in a sense have come and gone, and markets have digested them very smartly. So flows are stable. We found support from key technical levels. Valuations are not that stretched. The F&O positioning is light. Nobody is interested in really, taking long bets. There is lack of the lack of interest and participation in the market. These are typical telltale signs which tell you that in the month of April, you should be in for gains, considering the positioning is very, very, I would actually use the word featherlight. For me, the featherlight is the word.
And of course, as truncated as this week is going to be, it's also going to be extremely crucial as well, Nikunj. You've got the RBI policy, you've got the Q4 banking updates, brokerages will start coming out on their notes on what to expect from the IT sector, all important.
My view on RBI on Saturday was different Monday morning because the crude is very different. I don't think the governor also anticipated this kind of an jump in crude prices. I really hope this is temporary and he will not get too fixated with the spike in crude. But frankly, what the general view is that it's going to be 25 and no more. And that in a sense will set the tone for the market in terms of understanding the inflation parameter. They've already gone on record and have said that the worst of inflation is behind. Banks and the liquidity support, I think that also is looking settled. So it's not going to be a far cry to assume that markets or the interest rate cycle in India, maybe one more rate hike and it's nearing its peak. So second half of this year, if things really stabilize, in October, December, you could brace yourself for a cut rather than anything else.
Okay, and let's hear it out from Mahesh Nandurkar. He's talking about when historically the FIIs sell, banks end up underperforming. Let's hear out what his current view is on both FIIs as well as the banking sector.
What has happened with the banking sector is also that, in general, over the last 1.5 years, we've seen heavy selling from foreign institutional investors. And we've seen selling almost to the tune of around $30 billion, right? And what we've seen historically also is that when the foreign institutional investors sell, the banking sector typically ends up underperforming. But my sense now is that the foreign investor positioning in India is very, very light. In fact, I will go to the extent that to say that it is at the lightest level that I have ever seen in the last 10 years. Several large funds that we interact with are underweight on India. And the reason for them to go underweight over the last few quarters has been the extreme valuations. But as I mentioned, those things are correcting as we speak. So my sense is that from here on, the foreign flows should be on the positive side and not on the negative side. And that should primarily be one of the driving forces for the banking and financial sector, which is also incidentally the sector where the valuations have corrected quite significantly. They are trading at much below their last 10-year averages. So looks pretty attractive.
Now, are we in for a good day and a good week? It's a truncated week, but is the trend now very clear that it's time to chase the market rather than rather than wait for the fall? Now, for me, what matters is Reliance, the sleepy elephant. It came out of its hibernation and it almost was a 4% surge for Reliance on Friday. Now, that's not a small move. That's a mighty move in a stock like Reliance, which is 10% of the weightage. HDFC Bank gave it company. ICICI Bank gave it company. So the three horsemen, as I always say, Reliance, ICICI Bank and Infosys, if they are on the same side of the trade, then that means that institutional activity is actually very high. And on Friday, it could be year-end, I don't know. Data is data, money is money. The DI figure was extremely encouraging. Nuresh and Kunal are ready with us. Let's connect with them. I'll start with Nuresh. Nuresh, you would have a haircut?
Yeah.
Abhi to Bulls ka
The
haircut.
order
Abhi
it
the
gets.
Bears, it's time for the Bears to have a haircut or the Bulls to have a haircut?
I think Bears to have a haircut in a big way.
Why do you say like that? Why do you feel like that?
So if you look at the markets, what we've started seeing is good breadth. And overall, we've spent almost 18 months of zero return. We are seeing this momentum coming up across the world as well. So overall, say once the rally starts, it looks like a short covering move, but it could develop into a much larger move. So yesterday's move was the first indication, and now what happens is going forward, we go towards 17,600 to 17,800 and then see. But the small cap and the mid caps have already corrected quite a bit over the last 1 year. So stock specific opportunities are up. We could see one by one a lot of stocks do well. So overall, very positive period for small caps and mid caps.
Okay, Kunal?
I didn't have a haircut. So I think it's I think it's a good recovery. Last week, second half was a very good recovery for the indices. We managed to claw back about 17,000 first. In fact, 70,200 apparently was the resistance. So we managed to cross that level for the index. And we've seen this phenomena. Even I think in the month of February end, the markets ended the month of February end at its lowest point relatively. And from the start of the first week of March or the start of a fresh expiry, we saw the index moving up higher. So I think it's more of a replicative kind of a phenomena where the index tends to make a swing low at the end of the month and then restarts in a more rejuvenated manner at the start of the fresh calendar month. So I think the near-term targets which I would probably look out for in the index is 17,500 to 17,600 on the spot levels. But I think more importantly, the base has been established for the index, both for the Nifty at 16,800 and for the Bank Nifty at 38,500.
Okay, let's get going. Some stock ideas as well. Nuresh, on your list?
So still focusing on a mix of large caps and mid caps. So first is maintain a buy on SBI, which is yet to catch up with the rest of the banking space. The stock should ideally head up towards that 560 mark. A stop loss now revised to 510. Second is a buy on Indian hotels, which has gone through a sideways consolidation after that rally in 2021-22. Now it's on a verge of a breakout. Once it sustains about 330, I expect it to happen over the medium in the short term. So preempting that move, starting to accumulate at current levels, the stop loss at 310 and an initial target price of 360.
Okay. Let's connect with Vandana Hari and let's understand that how should one analyze the impact of crude. Vandana, good morning. Thank you for joining us. In a sudden move, OPEC has decided to reduce production. Is this desperation that they want to protect their market share because Russians are, in a sense, entering into side deals with countries like India and OPEC is getting desperate?
Good morning. So I think that might be one way to look at it. Look, OPEC Plus had always been signaling, especially since late last year, that they want to be preemptive, proactive, in case oil demand doesn't pan out the way that had been expected through 2023. But I think the latest move is especially shocking for the markets because I think it is a stretch, even assuming their preemptive and proactive stance. Because, really the question is, what did they see that the rest of the market hasn't? So yes, there was the banking crisis, crude crashed to 15-month lows, Brent below $73 several days ago. But it had, as the banking crisis fears abated, it had crept back up towards $80 a barrel, which is, back in the sort of comfort zone of OPEC Plus. And, the move really flies in the face of several things, including the Saudi energy minister until very recently saying that OPEC Plus will maintain its current production policy, which is before this Sunday's decision, the policy until the end of the year. And we had OPEC's monthly report just a fortnight ago. maintaining a pretty rosy outlook on global oil demand growth. They said it'll be about 2.3 million barrels per day year-on-year increase in demand. So surprising on several fronts.
Right, Vandana, what's the outlook in terms of, the overall weakening global economy, the fact that we have seen sanctions so far having had a limited impact on restricting those Russian oil supplies? In light of that, how would you look at this move?
So the Russian oil supply situation, I would say, is quite comfortable, and that would probably have been one of the reasons for OPEC's latest move. The kinds of disruption and supply cuts from Russia that the market had anticipated or feared through 2022 certainly did not materialize. Of course, Russia said that it will decrease its production by about 500,000 barrels per day. That's very, very minor compared to outages of up to even 2 million barrels per day that had been feared at one point last year. So that is not an issue. But the other thing that was a major dampener on the markets and partly explains OPEC's latest move is that Chinese oil demand rebound hasn't panned out as had been expected, or as, let's say, the most bullish in the oil markets participants had probably hoped for at the start of this year. So where does this take us in terms of prices? I think the latest OPEC Plus move doesn't really send them spiraling up towards 90s or let alone 100, in my view. I think what OPEC Plus is trying to do and will probably achieve by this move is put a floor under prices. So it seems to me that they were probably spooked by the crash in prices that we saw a couple of weeks ago in the height of the banking crisis. So they're probably trying to put a floor, anticipate, potential future such financial market shocks and perhaps having a longer term impact on demand.
So what are we staring at in terms of levels, Vandana? Because it clearly seems like a knee-jerk reaction for now, but would you say that maybe 84 on the Brent could be the new base?
Really hard to say, because again, I think it will depend on how Chinese demand pans out. Now, let's imagine that the best case scenario of the oil bulls does play out and Chinese demand recovers quite strongly. I dare say OPEC Plus will be under pressure again to put some of this oil back into the market. But again, going back to my earlier answer, as I said, maybe a floor. I don't think they are this move is going to push prices too much higher, because there is a lot of nervousness, there is a lot of risk aversion still in the markets, even after the fears over the banking crisis have abated. I think the Fed is going to continue tightening, so that is also a downward pressure on oil prices. I wouldn't bet on a sustained spike in prices as a result of the latest moves. I would say probably most of the reaction to OPEC Plus latest move is already baked into the prices that we are seeing right now, Brent around 85.
Appreciate your time. Thanks very much, Vandana, for giving us a heads up on how things are trending when it comes to crude oil prices and the impact of the OPEC surprise move. Well, we wrapped up our markets higher by about 1.5% on Friday's trading session, 17,359. Let's find out what Kunal Bothra is betting on by way of individual stock strategies as well. Kunal?
So I'm betting on large cap names, two buy calls. ITC is the first one, which I believe looks attractive. In fact, the FMCG pack has actually done reasonably well for themselves over the last, I think, 12 months as well comparatively. So ITC is a bet over the near term, targets of 400, stop loss at 375. And second would be Ultratech Cement. Again, I've been bullish on the stock earlier in the last, couple of weeks. Now that the stock has crossed that 7,600 mark, would up the targets to 7,880. Indicating a fresh buy, stop loss at 74.75.
Right, okay, here's the big exclusive voice. Over the weekend, we spoke with Aditya Puri, the former MD of HDFC Bank and senior advisor at Carlyle, and his wife Anita Puri on their new book, Aditya Nama. Here's a sneak peek of that conversation.
Long back when we used to talk, I said, "Ek din I want to set up a world-class bank in India." This was more talk, but obviously the germ of the idea was there at the back of the head. Then Deepak came along and he says, "Yeah, chalo, wapas chalo," and sitting in this 2-acre house, pool this side, golf course that side. So maine kaha, what's in it for me? So when he mentioned the salary, I was going to fall into the pool. So I said,
almost nothing.
As good as nothing. And there, a few of us, including Jerry, Nanu, and all of us had been named among the top 50 with John Reed. So prospects are very good. But then he says, you come here and do something for the country and set up a world-class bank. So I was frank enough to ask him, and I said, Deepak, that's very good, but who will run the bank, because if we have two people running it, we both will be miserable. He said, I have no desire, I've got enough to do. I have no desire to run the bank. You will run the bank. If you need something because you've been out of India, talk to me.
Now you're sounding even more bullish on India. Where is this bullishness stemming from?
It's not that I'm sounding bullish.
The action
The
is...
world is sounding bullish. You hear the World Bank? What does the World Bank say? I don't know what Prime Minister Modi did, but he's woken up an elephant. You see the procession of the foreigners coming in. You hear the IMF talk. You see the way the country is treated with respect. So that is there. But there are fundamental reasons. इस दुनिया में कोई ऐसे ही नहीं होता. It is because of the position we find ourselves in. The world is slowing down. The US will probably go from 1.8 to 1% or below. Europe will be in a recession. China went from 10 to 6, it will come down to 3. Hindustan, Jindabad, 6 to 7%. But more importantly, we are structured in such a way that this is Hindustan ka time for the next few decades.
All right, let's get a move on then away from that and focus in on crude oil prices and the impact on some of the companies back home as well. The former CMD of HPCL, Mr. MK Surana, is joining us right now. Thank you so much for taking time out. I just wanted to get in your initial thoughts on this move, given the fact that the world's largest oil exporters have announced that surprise cut in production.
Yeah, that might have surprised many. But I think it is more out of a fear that the price may fall further, and what we've seen in last few days when the price almost came down almost to 75 level. So I think the OPEC countries or the oil exporting countries are trying to support their base or put a floor price. And as I was mentioning that the possibility of the prices going higher or lesser now, and the downward risk is higher. So I think it is a move from them to ensure that the price do not spirally go down substantially. And one more thing, possibility can be there that normally when the prices start going down suddenly, the speculation zone makes it go down further. And I think so they have taken a preemptive step to provide support.
But Mr. Surana, this can't be spelling good news for OMCs, right? Because just about when crude was softening, did they make a comeback and you saw their marketing margins improve?
I think we should not be expecting that these cuts may lead to oil prices going to 100 or so. So I think while today it may be a sudden jump because of the news flow, but sustaining above 85 may be difficult with this also, in my opinion. And therefore, so prices should come back towards 80 or less than 80 in a short period of time, I suppose. And so it may not be that hurting. Of course, the oil marketing companies will prefer a lower oil prices, but there is a supply-demand concerns also in the mind of the crude producers, because the demand pickup except a few countries is not the way it is supposed to be. And the recession fear still is looming. And the Fed cut, which was supposed to happen, did not happen earlier. So there are various factors which are playing. And I still consider that probably this is a preemptive move to ensure that it doesn't go spirally down, because in the past we have seen that after a period of high prices, when it goes down below a threshold, it goes down very quickly for some time.
All right. So what is your outlook then as to how you are expecting, now the working capital needs, the marketing margin outlook for some of the OMCs shaping up in light of this move?
Actually, what will be coming today would have been already on the voyage. So it is not that today's price is deciding today's delivery. But if it sustains for a longer time, which I do not think is suggested by this move, in that case, if the fuel prices are not keeping pace with the international prices in the pump, then we may see some strain on the oil marketing companies because they were in the process of recouping their past under recoveries. And they would have been happier the lower prices for a longer time.
Mr. Surana, good to have you on the show today on ET Now and get in that quick reaction on what life would mean for OMCs because of this spiral up. Well, Mr. Surana is saying that this is at best a knee-jerk reaction and oil prices will settle back to around $80 to a barrel pretty soon. But KPIT Technologies, that's going to be in focus today as well in the back of a JP Morgan note. In fact, my colleague Anisha is here with what the note actually reads. Anisha?
Hi, good morning. Well, a bit surprising from JP Morgan because a lot of brokerages are actually talking positively about KPIT Tech. The stock has been hitting fresh lifetime highs for last many weeks and months. So a bit surprising, but perhaps JP Morgan believes that the best is already priced in and that's why they have initiated coverage with an underweight stance and quite a bit of downside is what they see. The stock is trading at what 900 plus levels and they are expecting that the fair value for the stock is around 520. So that's the important bit coming in. They do believe that auto R&D services in the fast lane right now given the shift towards electric, but they believe that uncertain macro is something which is a bit of a worry and that's why they're expecting a bit of a slowdown. They say India's share in offshoring will increase to 33% from 25% and KPIT is in this fast growing vertical, but they're expecting to enter at an attractive entry point. So the basic worry comes from the valuation point of view because if you look at the last 1 year chart of KPIT Tech, it has soared substantially and the reason is also the stock has been delivering 30% plus organic growth for the entire year. The margins have been quite impressive and they have been bagging order wins, but basically JP Morgan believes that the valuation is a bit unfair at this point of time, very expensive, and that's why a target price of 520 thereabouts coming in from JP Morgan.
All right, 520 is the target price. But Anisha, before we let you go, there's also Ultratech Cement as well as NTPC, and they're in the spotlight on the back of their Q4 updates. What exactly did they have to say regarding volumes and for NTPC, the installed capacity?
Oh, well, yes, it's actually a good number coming in from Ultratech Cement. It's better than what the street was expecting because if you look at the Q4 performance, they overall, achieved a volume growth of 14%, which means there has been a bit of recovery in Q4. We know that the cement demand has been quite sluggish, but at least in Q4, there was an uptick of 23% on a sequential basis. So that's the positive news. And even if you look at the grey cement volumes, that's jumped up by 15%. On a year-on-year basis. The total volumes for FY23 has crossed the 100 million metric ton mark, which is the first time it's happened for the company. This means that the company has been gaining market share. This means that the volumes number was strong and better than what the street was expecting. And perhaps the worst for the cement sector is over. And Ultratech Cement, given it's one of the best performing stocks and largest companies in the sector, is likely to gain. At least that's the word coming in from analysts. So that was about Ultratech Cement. For NTPC as well, the installed capacity has jumped up to 71.6 gigawatt. It's 4% higher on a year-on-year basis. But even if you look at the generation for FY23, that came in at 400 billion units. The street was expecting that the number would be closer to around 380 billion units. So there's a bit of improvement there as well. Though on the capacity side, a 4% increase is not much, even though the base is large. Talking about the electricity demand for the entire year as well, it was quite strong. In fact, almost a double-digit growth coming in for FY23. And the street believes that the momentum is likely to continue, giving the scorching summer that we all are expecting. So overall, positive trends coming in for Ultratech Cement as well as NTPC.
Thanks very much, Anisha, for giving us all those updates. Time to move on then, and defense stocks are also in the spotlight today, in particular BEL and HAL. A check-in on both the financials, and BEL's revenue was up about 2% in the final quarter of FY23, and you did see the FY23 revenues as well see a robust uptick of 15% at 17,300 crore rupees. The new orders came in worth about 20,200 crores, with the order book standing at about 60,500 crore rupees. That's up 5% on a year-on-year basis. You also had their export revenues that were up a solid 40% on year, coming in at $46.5 million. That's actually BEL that's in focus. Some of the updates that came in for BEL. HAL, in the meantime, then their FY23 revenues were up about 8% on year at about 26,500 crore rupees. The company has also said that they have received orders to the tune of 26,000 crore rupees, with the order book standing at a healthy 82,000 crores. A lot of big orders in the manufacturing space as well in the pipeline for HAL, so watch out for both of these stocks in today's trade.
Well, SBI continues to be in focus, and just last week we chatted with the chairman, Dinesh Kumar Khara. He's pretty confident of broad-based credit growth, and also says that they actually aim to clock 14 to 15% credit growth in this new fiscal. He also said that the bank is receiving payments from the Adani Group companies as well, and they have adhered to their repayment schedule so far.
The year which is we are closing today, of course, have witnessed a phenomenal growth in terms of the credit, and as also it has been very broad-based growth. It is not confined to only few sectors. But I think the way the trends are looking like, it is actually quite positive, I would say that. And I would say that the trends which are there in terms of the outstanding proposals which are still being processed, so also the sanctions which you have given and which have yet to be disbursed. So all said and done, I would say that as far as the credit is concerned, there's a very clear visibility of the growth in the coming year too. And if we look at the broader macro, the demand seems to be something which is quite encouraging, and it is both in terms of retail as well as in terms of corporate. The kind of investment commitments which are shown by various private sector entities and also by the Government of India in terms of the infrastructure focus which is there for the next financial year, which has been indicated in the budget. So it's about 10 trillion plus as far as the budget itself is concerned, plus 2.4 trillion from the railways. And invariably, the infrastructure spend has got a significant multiplier effect. So I would say that in view of all this, it is, I would say, the year coming in, the financial year 23-24, we expect a fairly good growth opportunities. And I think we are quite hopeful that we'll get to see decent growth in credit too in the next year.
Okay, and here's Neeraj Diwan telling us what he's liking right now and what are the stocks he's betting on.
Yeah, the stock I want to recommend today is KRBL. So they are one of the largest rice millers and basmati rice exporters. So recently we've seen a good build-up in inventory. The company procured 47% more paddy this year, and even the price has gone up by 15%. So the company, which is expanding into regional rice also, has announced a capex of about 250 crores approximately to be spent over next 2 years for increase in capacity of regional rice, which sells as a premium to the normal rice in the market. So the expansion in the margin will happen because of improvement in the price of the basmati that we've seen. Plus the growth will come because of increased inventory in basmati and the regional rice capacity which will come from this year and increase in the next couple of years. And plus the company has a Saudi business which was hit earlier because the dealer was not there. So they've not wanted a new dealer. So there's improvement in business from Saudi. Plus the company is even looking at appointing another dealer in Saudi. So there will be even continued improvement from the Saudi business. So all this together will translate into a top line growth of 20 to 23% over the next 2-3 years, plus improvement in margin that we're already seeing should continue over 22 to 24, about 470 basis points. So if I value this company at 11 times 1 year forward, I get a target of 415, which is the return of for 20% plus over the next 1 year. So I recommend this for investment for medium to short term.
All right, let's get a move on. And joining us live right now, we have Sandeep Sabharwal. Hi, Sandeep. Although there may be two holidays this week, it is a pretty critical one. You have that surprise move by OPEC, RBI policy, the Q4 banking updates, and of course, reports trickling in on the IT previews. What is it that you'd like to start off with?
Yes, I think the end of March was ended well for most of the global markets as people looked through the entire banking crisis that sort of played out at the beginning of the year, beginning of the month. So things seem to have stabilized. Like you rightly said, that the OPEC move has created an upward move in oil prices in the near term. So I think that could slow down the move of the markets for a few days. But I think directionally, markets are pretty well placed. This should not impact the overall outlook for equities unless and until crude prices just shoot up above $100. So which is not the base case because significant surplus capacity is getting created with all these cuts. So that by itself creates a scenario where oil prices don't move up beyond a point of time. So things are reasonably placed, like you said, and IT companies obviously will start reporting first next week onwards. I think next to next week onwards. So that will be interesting to watch because that's where uncertainty prevails about the growth outlook for the current financial year.
But Sandeep, surprisingly, some of the mid-cap IT stocks are already sitting at their 52-week highs. We were looking at the performance of a KPIT Tech, although there is a brokerage, stating that the best is already baked in, Cyient, etc. These stocks are still in a dizzy.
KPIT had a different story going for it, and that because of their work on the EV automation side and the kind of order flows they were getting. So I think that's on a different plane, and that's why it's been one of the outliers. Some companies are more speculative, so there we don't really need to comment on too much. But as a broad theme, IT has not done well. There'll always be some exceptions. Like initially we saw something like Tata Elxsi do very well when the rest of the IT space was not doing well, and then it fell 40-50% from the top. So I think these sort of things will keep on happening. Specific companies doing specific work, which is dealing from the overall IT cycle, might continue to do well. So KPIT is done well. Obviously, valuations have gone up higher, so it could go through a phase of consolidation. Longer term, it should still do well.
Looking at some stocks which are above the 200 DMA, and it's like when you look at the data, you realize that the biggest gainer last financial year was ITC. Then it is Britannia. Britannia has done extremely well in last 1 year. There you go, that's ITC for you. It may not do very well now, but in last 1 year, Britannia has done exceptionally well. Nestle also had a very strong Friday. It is now above the 200 DMA. So why are stocks like Britannia, HUL the high flyers in last 1 year? I mean, you would imagine that these companies have got hit everywhere. Competition, commodity prices, volume growth, and lower margins.
I think the reason is very simple, that despite all the headwinds, a company like Britannia has actually been able to hold on to margins. In fact, they have been able to increase it despite the huge inflation they faced on wheat, milk, etc. Now, some part of it is also because on the wheat side, they had some hedged exposures. So next year, and now that wheat prices are possibly correcting, so they might actually ride through this thing. Milk price uptake hurts all these companies. So how the pricing power plays out there, we need to see, because the hike in milk price has been the highest in the entire food category space. So the reasons why particular companies have done well is because they have done well despite the headwinds. And whichever company has done well despite the headwinds, we've seen those stocks do really well.
Meantime, let's get in a view then, Naresh, on the charts. Just going by the kind of outperformers that we saw on Friday's trading session, can't help but notice that Reliance Industries was on top of the heap with that 4% gain. At 23.31, what are the charts indicating?
So Reliance Industries has again flipped back into that band above the 2300 zone. So if you look at the history of the stock for the last 2 years, since it topped out in September 20, the stock has been finding support around that 2180 to 2300 mark. We broke below that. We tested the lows of February 22 around 2180, and we've again bounced back. Now the critical price point for the stock is once it sustains about 2450. That would indicate a momentum shift towards the upside. So for the near term, I would expect a dash towards 2100, 2450, and that would be a stiff resistance. So at current levels, the risk reward doesn't become interesting because a little bit of a gap up and then you are very close to 2400, 2450. So at 2450, I would expect some bit of a consolidation and then take a fresh view if it can sustain about 2450.
Yeah, that's the view coming in on Reliance Industries. Meantime, Sandeep, you've also got some of those defense stocks in the spotlight today. The fact that HAL, BEL have given their order book checks and things seem to be shaping up quite firmly and quite well. What's your outlook given the fact that their order book guidance is looking strong? And for both of the companies as well, you've seen the revenue growth that's been quite healthy.
Yeah, so the defense is a durable story where these companies have been continuously getting good orders. But the only thing is that these orders tend to be very long gestation, and to that extent, people should not suddenly expect that these companies will start growing 20-30%. That's not going to happen. It's a slow and steady execution cycle that will play out. And given the fact that the visibility is there for 5-6 years, the stocks become low volatility because of the fact that one, they don't have debt issues. Second, the orders are from the government, so to that extent there are no payment issues. And third, the execution cycle will play out. So these stocks continue to be so after the initial up move of the last 2 years. Now they are steady return stocks and should be part of portfolios.
Okay, now what did very well, I think, on Friday was Mumbai-based real estate companies. The new ready reckoner rates have not been changed, which means the stamp duty rates and the ready reckoner rates, which used as a benchmark for real estate, at least in the city of Mumbai or Maharashtra. Let me put it this way: they've not changed. There was a speculation in the market that could be changed, but thankfully that's not been changed. What it means, that's good news for Maharashtra-based real estate companies. Which are some of those Maharashtra and Mumbai-based real estate companies? Lodha, also known as Macrotech Developers. You've got Kolte Patil, large land bank in Pune and in Bombay. You've got Ubroy, very large land bank concentrated in and around Bombay. Godrej, hallmark prop projects in Bombay. Sandeep, how positive is this?
So because ready reckoner rate moving up was not the expectation in any case, I think, because it's not that real estate prices have actually gone up. So real estate deals have gone up, sales are happening, but prices are more or less steady. So to that extent, I don't think that there was an expectation also that it should be going up. Overall, this year will be more interesting to see because once those tax gains, tax set off about 10 crores of profits was eliminated in the budget, we saw a lot of large ticket deals happening prior to the deadline of 31st March. And that will boost the performance of many of these companies for this quarter, which is past. But then how do these high value deals play out this financial year, especially when rates have also gone up, will be interesting to see. Overall, I would think that as a basket, real estate seems to be fairly valued.
What are you buying as a basket? I'm not talking about shopping basket, I'm talking about market basket, not about what you bought for Sohani and how are you planning to buy or summer holiday basket, but stock market basket.
So, right. So I believe that Indian banks are very well placed. So Axis Bank, ICICI Bank is something which we keep on buying continuously whenever there are opportunities. Reliance looks interesting from these levels because it's got beaten down so much for a 10-15% kind of gain. L&T will continue to do well as a steady performer. And some consumer names I think on valuations look interesting. So Bata is something which we have been accumulating because that's got beaten down. It's not recovered at all. So that gives an opportunity to buy at lower levels. So, and on the mid cap side, uh, companies like VATech Webag, which has been winning good orders, and the growth outlook remains very strong. It still trades at around 10 times current year earnings with strong cash flow generation. That's something which I like.
Stay with us and let's move right on and put the spotlight on Piramal Pharma. They're going to complete their rights issue in Q2 FY24 and the draft letter has already been filed with SEBI. Let's take it across to my colleague Sharad Dubey who joins in with all the details. Sharad?
Well, yes, a strong rights issue coming in of more than 1,000 crore from Piramal Pharma, and the important thing is that draft letter has been actually filed with SEBI and is expected to be completed in the second quarter of FY24. Now, looking at the stock, it has been actually listed after the demerger at almost 200 rupees per share on the bourses. But if we see from the listing itself, it is down almost 66%, and this year, if we see, the stock is down almost 40%. So the important triggers for the fall. This includes, of course, a price discovery coming in after the demerger and, of course, weak set of quarterly numbers coming for the third quarter. And lastly, there has been a very lukewarm reception when it comes to domestic institutions actually increasing stake in the company. Apart from that, there are some recent triggers which might actually augur well for the company, at least in the medium to long term, which includes lower freight rates, which actually will aid the margin expansion. And apart from this, also the company recently received zero observations from its Digwal facility. The brokerages are stating that the valuations have turned attractive, and even Jeffrey stated in a note that from the second half of FY24 the CDMO business will turn actually on a positive note. And do remember, almost 60% of sale comes from the CDMO business. Now also there was a guidance which was given by the company to ET now. They have stated that they are going for a long-term growth of 15% in the top line and expecting EBITDA to go up to 25 to 28% in the next 3 to 5 years. By FY25 they are aiming a 10,000 crore revenue, and we did check what the analysts are also stating going ahead, and out of the 5 analysts tracking the stock, all of them have a buy rating and they've given a 12-month combined target price of 116 rupees per share. Now that indicates almost a 70% return potential from the current market prices.
Thanks very much, Sharad, for those details. Top fundamental stock ideas then. Let's hear it out from what Sanjeev Bhasin is looking at.
SW Solar is the largest EPC player in the world. It is the sole agent for providing EPC and MEP for any solar panel and PVs. And Reliance Energy now has a 40% stake. I just had a conversation some time back with the management. They had an order book of 800 crore till last year. This year they are executing 4,000 crore. And by next year, it can even touch 10,000 crore. They have a margin of 11 to 12%. So you can imagine the bandwidth this stock has to create wealth. It is just an 18 crore equity. Reliance Energy owns more than 40%. And if you do your homework and sit still for 1 year, I can guarantee you this year it will be a doubler. Wanted to pick particular stocks in your portfolio, then I think stick with the large caps. Dr. Reddy and Sun are 2 large picks. Lupin has always flattered to deceive, but now the management seems very keen on increasing market share. Their generic pricing are improving, and I think they've been through a lot of the problems. So at 700, I think that gives you a very good risk reward.
Scanning through some stocks where there was a bit of a mid-cap activity, and the other one, Interglobe Aviation is not mid-cap, but it's not entirely large cap in terms of the market cap also. But Interglobe Aviation, it saw a breakout. It went above 200 DMA, but just because crude prices are down, will this entire space get challenged? Sandeep, I want to go back to that point on crude, and we can argue both ways. Argument number one, pure desperation by OPEC because they are losing market share. Russian oil, Russia has entered into side deals with countries like India, and the oil supply has not got disrupted. Second, they also feel that the demand is getting punctured. China is not consuming as they were expected to consume after opening up, which means OPEC in a sense is telling you a clear message that commodity prices have peaked out, demand has peaked out, and inflation will come out.
Yeah, so there was an expectation, like you rightly said, that once China opens up post its COVID restrictions, we'll see a revival in fuel demand out there. But I think first 3 months data shows that that's not really happened. And that's one of the key reasons why crude has been weak, ex of the issues around economic growth, monetary policy, etc. So both aspects are right. They are getting desperate for higher revenue in the short term because of the fact they realize that in 5-10 years, as EVs become more mainstream, the demand will only moderate instead of increasing. So they want to get as much as revenue now as possible. So the challenge for other countries is only if the crude actually goes above 90-95 and sustains there. So a 5-6% move is perfectly fine because of the fact that crude actually fell so much and reached a 15-month low last month before now reviving with these moves. So overall, let's see how it goes. It's very tough to predict crude oil prices, but it's clearly a desperate measure.
Tejas finally looks like they've got the BSNL order. Now, this was the most talked about order, which in a sense will come to TCS, and then from TCS it will go to Tejas. Tejas is now Tata company, and they are in the business of executing a lot of 5G and 4G rollout. Now, BSNL of course is not going to be in 5G. It's the 4G impending rollout which has been overdue. So this is an important news. Also, there is a change of guard at Tejas, the erstwhile promoter who had a very low holding in 696 crore. So does that mean it will go back to, does that mean that the BSNL order for TCS is also coming, or this is just one of the side orders? Now Tatas are trying to reboot Tejas very, very differently, but somehow the order wins from the government stable for Tejas has not been extraordinarily strong. That is something which is really, worth revisiting once again. I want to go back to the entire, construct of IT. We've discussed this with Sandeep already, but Kunal, markets are approaching IT stocks with almost zero expectations. 2 quarters ago, it was only glory days for IT. Now it is that period where everybody thinks that nothing could go right. Could IT be that real, risk-reward ratio bet where you buy it before the results and sell it after the numbers?
Yeah, in fact, last week also we were discussing, Nikunj, that how the fall in Nasdaq initially in 2021 was a precursor, to a correction or an impending correction into these IT stocks. So I think from mid of 2021, when Nasdaq had started to get into a correction, the effect percolated into the IT stocks, with a lag of 3-6 months. And from Jan 2022 is where you saw the Nifty IT index go into a correction. Right now, when you look at the setup, the last 4 or 5 months, we've seen the Nasdaq forming a good base, rising up by almost 20% from its previous major swing lows. And that in itself could probably have a positive effect. So it's a matter of time that these large cap IT names would probably make a strong comeback for itself. I would believe that the initial bias should still be on the larger cap front, the likes of TCS, Infosys, Tech Mahindra. These should be the top priority names, I would believe, from the large cap names. From the mid cap stocks, traders can either pick out for stocks which are already riding on high momentum, KPIT Tech. I think there's a persistent, and Cyient, which is doing pretty well for itself. So there are a few pockets of stocks which could be concentrated on the mid cap IT names, but I think the larger bias should be on the large cap IT names. And my sense is that it's a matter of time. Maybe in the next 1 or 2 months, you could see a formidable bottom as well as a strong rally which can come back into the IT stocks.
Okay, just a span of time and a short one at that, and you could see IT stocks actually rally from the current levels. But the government has kept gas prices unchanged, and GAIL is a key subsidiary or beneficiary of the lower APM gas prices. That is what Citi's note is saying about gas stocks. In fact, let me take it across to Vamakshi and find out what's more in there. Vamakshi?
Well, absolutely. When we look at some of the expectations that had come in, they were expecting that the Kirit Parikh committee recommendations would be accepted by the 1st of April, and that in turn could have led to a cut in domestic APM gas prices to nearly $6.5 per MMBTU. But what has transpired is that the government has kept the prices largely unchanged at $8.6 per MMBTU for now, and this continued delay in decision making could create a near-term overhang for the CGD stocks, is what Citi believes. Implementation of the new gas pricing mechanism is only a matter of time, in their opinion. Now, any stock correction that could happen on the back of this could be temporary, is what they believe, as the price cut would only improve the CGD's near-term as well as medium-term volume as well as margin outlook, especially for the CNG-focused companies. Overall, Citi continues to view the stance of government towards the CGD sector as a whole as quite favorable, and in fact the top gas pick is GAIL, which also happens to be a key beneficiary of lower APM gas prices. As far as the CGD space is concerned, that preferred picks are MGL and IGL. So on the back of this note, gas stocks in focus.
Thanks very much, Vamakshi, for giving us those details. In fact, let's get in, Sandeep, your take on this entire space as a whole. Going to be in the spotlight. What's your outlook?
Unfortunately, I don't invest in this space wherever there's so much of government intervention and we need to depend on so much tweaking and decisions by the government for the fundamentals to change or on either ways.
Okay, that's the outlook coming in. Meantime, Kunal, let's get in a take as to what your sense is on some of those names that did buck the general trend on Friday's trading day, Sun Pharma and even Asian Paints.
So Asian Paints apparently has been, I think, a stock which has underperformed, and the stock has broken the correlation with respect to crude oil, because earlier, I think 2021 or 22 first couple of months when the stock actually topped out at 3,500, that was the point when crude started to spike, and then when crude oil prices started to correct, the stock also went to a further correction mode. So it's not been able to find that like-to-like correlation. So possibly it's a phase where Asian Paints is underperforming. My sense is that possibly in the next few weeks, the stock could get into a bottom formation process. We are very close towards the oversold indicators on the charts for Asian Paints. So maybe over the next couple of weeks, if the stock drops by say another 5%, 7%, then I would believe that a good contra buying opportunity could be taken on Asian Paints. Sun Pharma, on the other hand, I think has been one of the stronger, more formidable pharma names. But there are other pharma stocks which are also emerging as strong breakout candidates. Oro Pharma has been doing pretty well for itself. Glenmark Pharma, Zydus Life, even these stocks have managed to make a strong comeback in the last 1 to 2 months. So I would still stick to large cap pharma names as of now, but then mid cap pharma names like Glenmark, Oro, as well as Zydus Life, these are also posing very good short-term trading opportunities.
Okay, that's the take coming in pharmaceuticals. While yes, it was all to do with Reliance Industries in Friday's session, there was also ICICI Bank giving it due support. The stock managed to hold out almost about 3%, and ICICI Bank is now back to almost nearing that 900 rupee per share mark. 877 is where it shut shop in the day. Sandeep, you've liked quite a few banks, right? From IndusInd, Axis, ICICI, to, for that matter, SBI as well. But if you had to add positions at the current levels, which is that one stock that you'd pick out from banks?
So IndusInd is something which we haven't bought, but I think from the banks, I believe Axis and ICICI are best position now from a risk-reward standpoint, taking into account the valuations. Like, growth might be good for other banks also, but from purely a valuation to growth paradigm, I believe these two look better to me.
IndusInd Bank, it's just a pure play bank. Axis has got a credit card business, they've got insurance business. SBI has just covered everything. ICICI Bank has just about everything. Here's IndusInd Bank, which acquired Bharat Finance. It has struggled to turn around that microfinance business. They don't have a presence in insurance and very little presence in the brokering business. Sandeep, why IndusInd Bank?
No, I said that we haven't bought IndusInd Bank lately over the last few years.
My bad, I just completely missed that one. 1067. In fact, if you frankly look at IndusInd Bank has underperformed, even though this whole appeal of IndusInd Bank, which is very cheap, time and again it is on the book quality front that the markets just get slightly unnerved. It's a cheap stock, There was a time when it was trading at a price to book which was higher than that of HDFC Bank, but that was a different pre-IL&FS era. After that, lot of changes have happened in terms of the lending and in terms of the aggression. My limited point is that they're growing at a rate which is equivalent to that of HDFC Bank, and the book size is dramatically different. So if a bank of the balance sheet size of IndusInd Bank is growing at a rate which is lower than HDFC Bank, it just tells you that either they're careful about growing or perhaps they are in a mood to perhaps grow very, very differently, at least in this decade. I'm going to go back to Reliance once again. It's slightly repetitive on this one, but that's a stock which really made all the difference last week. Kunal, is Reliance looking good for another 5% from here?
Yeah, it is, and I think so. The real move for Reliance actually started off 2 weeks back when the stock started to get into that first zone of price falling breakout from I think the day post the stock had hit levels of 2,200 and below those levels. So I think that was the first candlestick move for Reliance Industries. The stock showed a very good surge of volumes as well in that time period, and then post that 2 or 3 days of mild consolidation in the stock, making a fresh comeback on Friday, especially on the back of news flow for the stock price. So I believe that that's a very strong setup for the stock price: an initial up move, mild correction, and then a stronger up move which has been reinstated with some kind of a news flow. This establishes a strong support for Reliance at the 2,200 mark, and we typically see that the extent in which the stock moves up, so 100-120 point up move for the stock from that 2,200 levels, that is the kind of upside which one should be looking out for. So 2,450 approximately could be a near-term target range for Reliance Industries.
Okay, that's the take coming in on Reliance. Seems like more upside to go. But Sandeep, we'll let you go on that note. Good to have you on the show as always. Let's also focus in on the auto majors. Maruti, remember, came out with its sales data, and the March sales are better than expectations at 1.70 lakh units for the month of March. Let's welcome on board Shashank Srivastav, Senior Executive Officer, Marketing and Sales at Maruti Suzuki. Shashank, good to have you on the show. You've announced further price hikes this month onwards, but impending this price hike, was there any pre-buying by customers in the month of March? And if yes, then which are the segments and models which did well?
Actually, yes, there would have been some element, I think, especially because we saw in the last week of the month, there was a big push towards retail. So the retail was pretty strong in the last week. But then it was also the week for the Navratra. So it could be a combination of the Navratra and the people trying to beat the price hike, which has resulted in the stronger retails in the last week of the month.
Reports are suggesting that there have been some drop in inquiries over the last recent months. Can you help us, throw more clarity on that?
Actually, inquiry levels haven't really fallen for us. About even in March, it's about 25%, 23-24% up over last year. But then why people are saying that there is a little bit of softening is because the booking figures, which is the next stage when people actually try to convert, towards the sale. The booking figure has softened a little bit. And while for us it is still positive, but a small positive. And if you remove the bookings for some of our new models, which were not available last year, the Fronx and the Jimny, then it comes like a flat. And that is the reason why people are talking about softening. So it's not a very large softening, but it is definitely a little bit of softening can be observed, especially if you remove the bookings for the Fronx and the Jimny, which are absolutely new models.
And what about the latest launches, the Jimny and the Fronx? What kind of bookings have you seen here?
So Jimny is now very close to 25,000 number, somewhere between 24,500 to 25,000, and about 16,500 for the Fronx, total of about 41,000.
Right. Do you also expect some moderation in sales because of the rate hikes, the price hikes, etc.?
So we made a rough consensus in the industry regarding the next year's demand. Roughly, it was about 5 to 7% growth over the current year, figure of 38.9 lakh almost. This will go up to about 40.5 to 41 lakhs next year. That had been the consensus about 2 months back. We haven't really revised these projections. But of course, there are some factors which we have to be wary of, and we are closely monitoring these red flags, which include, of course, the overall economic growth itself, which we have taken about 6.5% growth, but there are some reports where economists are projecting a 6 to a 6.4% type of growth with a negative bias. So that's one red flag. The second red flag, obviously, is the interest rates, which have gone up for the auto loans. Between 180 basis points to 250 basis points. As you know, the repo rates have been increased by the RBI between from May to current year levels, current level of 6.5%. That was an increase of 250 basis points. So it's a lot is dependent in auto retails. 80% of the retails happen through auto loans. So that's the other red flag. And of course, the price hikes which have happened in response to the commodity prices increases, also the switch to BS6 phase 2 norms, which come into effect from today. So those combination of factors are something which we are closely monitoring just to see if we have to, if it has an adverse impact on the overall demand projection. And of course, the final thing is about the El Nino, which is a seasonal, which is a pattern of weather where the monsoons become irregular, in which case you could see an impact on the rural sentiments and in fact the agricultural incomes. That can also have an adverse impact on the overall demand.
Has the production normalized? What are the projections for April? I mean, is the chip shortage behind?
April, we are still working out, because I think the problem of semiconductor continues in April also. We had, as you know, in Q3, lost about 46,500 vehicles. We lost a large number of vehicles in Q4 as well. And I guess in April also the problem would continue. Exact number is difficult for me to know, because we are still evaluating how much production is possible. Both for us as well as for the competitor projections. So maybe a little later, in a couple of days' time, we'll be able to give you our projections for April.
Appreciate your time. Thanks so much for joining in, Mr. Srivastav, and giving us a view on the sales bookings and how things are shaping up. Moving right on then, let's get in a take. And Kunal, just curious as to whether or not you've been tracking the crude oil price chart, and given what we've seen emerge overnight, what are the charts looking like?
So it's still range bound. I would still say that I think $75 plus or minus, or maybe $78 plus or minus $8 odd is the range for Brent crude. In fact, the crude oil prices had actually managed to make a very longish kind of a bearish head and shoulder pattern when the breakdown happened, I think at $85 or $88 for Brent crude, and from there we saw an initial bout of sell-off coming to I think $72 odd. So I would probably expect that that 85-88 mark on the upside could actually remain as a major resistance for Brent crude, and the sense is that the prices could still stay a bit more on the lower side because of the pressure of this bearish formation for Brent crude prices. I would expect the prices to somehow settle into this $75, $78 mark back again. So my expectation is that if it comes back to say $85, $88 per barrel mark, then I think it's a good time to maybe create a fresh shorts for someone who's trading commodities.
Right, time to get in some mid-cap strategies as well. Naresh, you go first. What's on your list?
So that would be a buy on Bharat Electronics Limited. The stock, after making that retest of 85.90, consolidating on Friday, finally saw a big uptick. That is generally possibly a start of a new trend. So any fade off today would be a buying opportunity, and I would expect it to go towards a new 52-week high and an all-time high. The last highs for the 3-4 weeks is around 98, 99. Sustaining above that would confirm a breakout. So a buy at current level, stop loss at 92 and a target price of 115.
Kunal, let's get in your mid-cap calls.
So it's a buy on Policy Bazaar, a stock which I've been bullish on earlier. I think it's managed to break past about the 600 mark on Friday. 630 I think was the closing for the stock price. So would suggest a buy. Revised target on the upside to 675. Traders could look at a fresh buy even at current levels or on minor dips. Stop loss to be kept at 620.
All right, let's get a move on. And here are your top Fatafat headlines. Global fast food giant McDonald's is reportedly closing its US offices this week as it prepares to inform employees about the layoffs that have been undertaken as part of the broader restructuring. The company has asked the employees to work from home over internet, email, and what's unclear is the exact number of employees that will be laid off. Meantime, car maker Tesla has delivered record quarterly vehicle deliveries. However, the sales growth has moderated despite the price cuts as rising competition and bleak economic outlook have taken a toll. The company has reported 422,000 vehicles for the first 3 months for this year, up 4% and 36% higher compared to last year. And after massive job cuts earlier this year, Google has now announced cost-cutting measures that include a focus on prioritizing its work in artificial intelligence. The announcement came from Ruth Porat, who is Google's chief financial officer, as well as Prabhakar Raghavan, the company's search lead.
And UBS Group says that it's going to be cutting its workforce by 20 to 30% after completing its takeover of Credit Suisse, which is as many as 36,000 jobs worldwide. In fact, reports say that Swiss prosecutors have started gathering evidence as a part of the possible criminal investigation into the deal. And at least 26 people have been killed after a series of tornadoes and deadly storms struck through the towns and cities in several U.S. states, including Arkansas, Tennessee, Illinois, Indiana, Alabama, as well as Mississippi. And back home, Royal Challengers marked their homecoming with a dominating 8-wicket win by beating Mumbai Indians. The win was set by the RCB bowlers, and all eyes are now on the action-packed match between Chennai Super Kings and Lucknow Super Giants at the Chidambaram Stadium in Chennai tonight.
All right, let's get straight to those index calls then. 17,400 thereabouts is what the pre-open rates are indicating. Just about 4 minutes to go, and we'll be opening for trade with a fairly healthy handover from across the globe. Let's find out what our chartists are advising this morning. Well, it seems to be pretty much tilting towards the hold side when it comes to Naresh and Kunal, although Kush believes that it's a buy recommendation on the Nifty index this morning. After last week's slight outperformance, that's what the market moodometer is indicating. Hold on to the Nifty positions. What about the Nifty Bank Index then? Ditto, it's a hold call coming in from majority of our participants, but that's Kush who has a buy recommendation on the Nifty Bank. The market moodometer on both the Nifty and the Nifty Bank, it's a hold call.
KRBL and you got Neil Sterling. These are two good old ideas from Sanjeev Bhasin and from Neeraj Dewan. So Kunal, the risk reward ratio. How much on a scale of 1 to 10 going long, the risk reward ratio now, favorable or not favorable?
For an intraday trader?
Yeah.
Well, I think it's less than 50-50 to go long over here for an intraday trade because we've already seen a jump of 250 plus point for the Nifty on Friday. We are seeing additional maybe another 50-60 points up move for the index, and now we are heading towards that 17,500 mark, which could, and these round figures at the start of the month, they generally act as strong hubs for option writers. So that's where the index generally tends to take a pause for at least a couple of days before it tends to move up higher. So now at 17,430, 440 on the spot levels, so the room on the upside is just about some 50-60 points. So I think in that regards, I would not suggest to build up any fresh kind of a trade. But for traders who've been holding on to the long positions built on Friday, they can have a trailing stop loss, maybe up the stop loss from 17,200 to 17,300 and keep on riding the upside.
Naresh, risk reward ratio for a day trader.
So the risk reward ratio is no more favorable at 17,420, 430 if it opens around that area. So for now, it is more time to look at more stocks rather than the index. Say if we get a dip to 17,350 in the day, then maybe one can take a bounce back trade from that price point, wherein we could again go back to 17,450 to 500 over the next couple of sessions.
Okay, bunch of other stocks which are going to be in focus and active this morning. Let's see what the auto pack is up to and whether or not you're seeing any reaction to the March sales, considering Maruti definitely was better than expectations. The sales numbers came in at 1.70 lakh units. That's Maruti that I'm talking about. Stock holding up a good 120 points higher. 8,400 is where Maruti is. For even Eicher, Royal Enfield sales have come in higher by about 7% on a year-on-year basis. 72,000 to 35 units is what they've managed to sell in the month of March. There's Hero MotoCorp as well, wherein the total sales also have come in at 5.19 lakh units, beating what the market was anticipating, 1.6% higher for Hero MotoCorp. BEL and HAL, we just told you that the FY23 revenue has come in higher by 15%. For BEL, the revenue and order inflow is pretty much in line with guidance. HAL, the FY23 revenue uptick is about 8%. The order book as of 1st April stands at a solid 82,000 crore rupees. And both of these stocks are the ones which are in focus, Nikunj.
All right, a brand new week, truncated one, but a brand new year, which is more importantly. FY23 was not like the most exciting year, but look at the news which had hit us. War, Adani, sale of an Adani group of stocks. If that was not enough, crisis in US regional banks, and yet Nifty was actually flat despite the bombardment of selling by foreign institutional investors. We start fresh. It's